All right, everyone. I'm very excited to be able to share this presentation with you about our recessionary income fund, which I'm just super excited this time we're at right now in a recession to be able to share with you a way to get a more stable form of income through being a higher stack in the or a better placement within the debt position. So I'm going to start sharing this with you. We're just going to jump right in here. So let's go ahead and jump in. Let me share my screen here. So this is the Bronson Equity Recessionary Income Fund. It's a real estate asset-backed debt investment. Some quick disclaimers here is nothing here is an offering for a specific investment. We only receive your offer once we look at all your information and we choose to, we review and we're able to actually make this offer to you. This is for 506C investors, which is an accredited investor. There's a net worth or a income requirement. We'll get into in a little bit. And then this is the investment sponsors just that are here. I'm going to do a quick intro, and then we're going to jump in and have them share as well. So we've got myself, CEO of Bronson Equity. If we have not spoken before, it's great to be able to connect with you. This is my good friend Patrick Grimes, who's the CEO of Passive Investing Mastery. And we have Lance Peterson, 20-year lender, who is with us here as well. So a little bit of my background here. I'm a general partner in 2,000 multifamily units worth about $200 million. I'm the host of the Mailbox Money Show. I wrote this book here. We also do ATM machines. We've raised over $40 million for real estate and other ATM machines and other sorts of alternative assets as well. And then I was a medical device sales rep, worked 9 to 5, and had some single family portfolio, raised some money for multifamily, and was able to scale up over time. This is my good friend Patrick Grimes. He started in as an engineer in automation and robotics, went into real estate and did some single family stuff, founded Invest on Main Street, started going after much larger deals, scaled to 600 million and 4,000 units, written a couple books here. And the things that he writes is into energy, oil and gas, and alternative investments. So that's a little bit about Patrick. And then down here we have Lance, who is, he founded a IT services and security firm in 2000, managed a commercial real estate debt fund in 2008, and founded a real estate fund administration firm, and then scaled this group called Verivest to about $3 billion in asset under management, and half of it was real estate debt funds. So he has about 20 years of experience, 15 years of experience in the space as a lender, working with these types of deals. So, and this is really the real estate stuff that they have lended to, about $1 billion in real estate. And I was the CEO of a private equity firm, and this was the group called Fairway America, where he did a lot of his lending through this group. And then he joined Passive Investing Mastery as the chief investment officer. So we're going to get into kind of a little bit of this here right now.
All right. So in combination, we have quite the background in debt and equity. And I think that's important to say because probably most of the investors on this call are equity investors, as what Bronson was saying. We're going to go a little more detail on what the differences are. But from a debt perspective and equity perspective, there's 57 million in loans.
Yeah. So yeah, like I mentioned before, private lending's really my background. Spent majority of my career in the real estate space doing private lending. Our loans were a bit, on the smaller side, around $500,000 in average. And we primarily focused in the Pacific Northwest, so Oregon, Washington, Idaho, and did some stuff in California as well, but mainly on all commercial real estate. So it was a lot of owner-user type commercial real estate properties.
Great. Okay. Why level alternative? So I was going to go over these, just a little bit about alternative investing and kind of where this fits in your portfolio. So this is something that's really interesting when you look at how the wealthy invest. They typically will have 50% of their assets in alternative assets, such as real estate. And then you see over here, for a lot of people, there's something called liquid assets. This can basically provide multiple places in your portfolio where you can have something in real estate where you have upside, you have equity. There's actually an equity way to participate here. And then there's also a liquid asset portion. So this investment, as we talk about, you can have funds tied up as little as 90 days. So it's really nice if you have funds sitting there, you're just looking for something lower risk. It gives you exposure to real estate with potential upside with equity, as well as having liquidity. And then like we talk about here, this is Tiger 21, which is, I think you have to be over net worth of 10 million to be a part of this. They do their member. It's a group that has high net worth people in it. And they say, where are people invested? What percentage are they invested in? And you see A lot of it is in alternative assets, over 50%, 27% in real estate. And this fixed income over here, this is something that a lot of people don't think about, that you actually can invest in this type of investment, and be at a very low risk and get better returns than bonds or treasuries or things like that, where you're getting some sort of fixed income from, which is very nice. And people love anything we do. That's our ATM fund is a little similar, where it's a steady kind of payment. It's just great to have something that does have some cash flow perspective, element to it as well. So I'll turn it back over to you, Lance, and we'll just kind of keep going here.
Yeah, so the fund that we're talking about today is the Recessionary Income Fund, also known as the PIM Income Fund. And it is a debt fund, which just means that we have loans that we're originating, which have asset level equity at the asset level. So someone else is investing equity down at the property level, and we're lending them money in first position against those properties. So as Bronson was alluding to, we have these more fixed income type replacement, or more of a liquidity option in the portfolio. We have notes that we issue. You basically are borrowing money to the fund. You have three options. You can buy a note that's for 90 days at 7%, 180 days for 8.5%, and then, or you could go for a 1-year note at 10%. And that's going to put you in a senior secured position, so that the membership equity, which we'll talk about here in a second, is subordinated to the note investor's position. So you
Just
get
a quick note here too. This is
cash.
really interesting to note that you have shorter term stuff that you can get these kind of returns, annualized returns on, which usually we don't see this. Usually you'll see higher returns, but for longer duration. So it's just nice that you can have, hey, I'm not going to want to wait 6 months and see how things looks. Well, it's 8.5% is the monthly payout for this fixed return, which is nice. And then we have, like you said, these other. Maybe you want to talk about the short-term benefit.
Yeah, so the benefits we kind of hit on is that you're in a senior position to the equity investors in the fund, and then you also have the cushion of the asset level equity. Our average loan to value when we're making a loan is 60%. So you have 40% of equity down at the asset level, in addition to the equity from the members. So you're high and dry, as I like to say. And then we do have a reinvestment option, so your ability to compound that. So through a retirement account, that's great. You can, buy a note for a year, and you get that, monthly compounding going on at, 10%. So, and then you do have those fixed rates. You're locked in for the whole period, whatever rate that is, that's 7 for the term that you're at. And then it's just, giving those just better liquidity than you'd get in traditionally. You buy a CD, it's a 3-year CD or 5-year CD, right? Or treasuries. It's just you're kind of locked up a little bit longer to get what ends being a lesser return. And then the flip side, so you have, in addition to the notes, you can invest in, a longer term investment. So it's actual membership equity. And this is a typical, preferred return with some profit sharing above and beyond that. So we have 2 classes of shares. If you invest between 100 and 250,000, those are the Class A units, and they'll give you a 9% preferred return and a 50-50 split. Or you could, anything above 250,000, you get Class A shares or Class A units that have a 10 pref and a 60-40 split. So you invest a little bit more, get the Class A shares, you get 1% additional in pref and a little bit better of a split above that. So we're running for annualized last year, we were at 15.1% annualized. We project 12.5 for the Class A and 11% projected returns annualized for Class B. And the lockup period is 3 years.
Just want to clarify too, real quick. We have 2 different types of investment. We've got the shorter term stuff that's typically, less than a year. And then this is more the longer term, where you have a profit share, right? So you get kind of the 11 to 12.5%, and then you're getting some upside as well from the profit that's actually being gained from us originating these loans to investors.
Right. And there's a question about the short-term notes. Those you can either redeem or you can roll them forward, right? 90-day increments, 180, 1 year. Whereas this one is different. It's 3-year lockup, but you can leave it in either compounding monthly, or you can leave it in for longer until you choose to do a redemption.
We have the reinvest option for that too. So we do monthly distributions, so you can reinvest. So we kind of hit on this. It's just ultimately some of that additional return you're getting is that we have a lower cost of capital on those notes. So we do get a bit of that, you get to share the upside whereas the fixed rate people are just getting that fixed rate for the better, position and the capital stack.
Great. Okay. And we'll keep going. Okay, great.
Yeah, we keep hitting on it, but the reinvestment option, obviously compounding interest is the eighth wonder of the world, according to Einstein. He who understands it earns it, he who doesn't pays it, right? So that's a really great feature. And the reinvest is also great. Like keep going back to the retirement accounts, but it's just nice to be able to invest from a self-directed IRA. You get those, those returns that just keep compounding rather than having idle cash sitting in your retirement account and trying to figure out where you're going to place it.
Yeah, that is great. We will take some questions here at the end too, so feel free to. I've seen some questions come in, but we'll keep going here.
Yeah, so who's investing with us? I mean, you can kind of flip to the next slide. So we do have, I mean, primarily, high net worth individuals, obviously retirement cash flow, we've hit on that. Someone who's looking to have that, portfolio growth. It obviously is, it's an inflation hedge. We've experienced, crazy inflation here the last few years, which seems to be somewhat under control, but still has a volatility. So you're just outpacing inflation, protecting your purchasing power. Obviously, with an investment like this, it's just more designed, it's a capital preservation. You're not trying to hit home runs and triples and, things like that. This is just about maintaining that capital preservation and ultimately just diversifying out of some of these other, banks. We hope that they don't have more trouble, but we've seen some bank failures in the last few years and some issues with FDIC insurance and stuff like that. So it's just a great way to kind of diversify out of those other cash equivalent type investments. And then we do have, some of these other features if you happen to be a fund manager that are nice. It's just it's a place to park if you've got in between investments, capital you're looking to place in those shorter term notes. It's be a great solution instead of just sitting on idle cash, or just finding if you're raising money for a potential deal, just have something to be able to bring that capital in, place it into the fund, and then when you're ready to close on an investment, you can close on it.
Is this the correct presentation I'm sharing, or is this do you think this is the right one?
I think it's the right way. It's the right one.
Okay, great. Make
Yeah,
sure.
and then our buddy Robert Kiyosaki, right? If cash flows into your pocket, it's an asset. If it cash flows out of your pocket, it's a liability. So it's all about cash flow. I know Bronson loves the cash flow with the Mailbox Money Show. So
Exactly. I love it. So this real quick, there's a link here, bronsonequity.com/debt fund. You can also scan this QR code with your phone. If you're interested in getting more information, this is kind of just a break in the presentation here. What we're asking people to do process as you go, and you just real quick, just put your information in. I'm interested in joining, more information about this. We will follow up with you on steps to be able to do it. You'll get a link to the portal, which you can log in, and we'll get you kind of next steps on that. So you can feel free to also reach out. We've got a phone number here, and we're gonna share this again later, but I just want to show this to you now. So go ahead and get that, take a picture of that, or grab the website there, or put your phone up there, and then we'll go on to the next thing.
Well, the real estate capital stack is kind of a big word. Lots of people talk about what does that mean, the real estate capital stack, and what is common equity, or what is equity, and versus what is debt, and what are these other weird things like preferred equity and mezz debt. And really, it's important to know how you can invest in real estate. As Bronson pointed out earlier, there's various ways to allocate your capital, and the wealthy put 26% in real estate. It's a lot, but how can you do that all in equity? And essentially, the easy way to understand equity is if you're buying a single family home, you put a down payment up, that's your equity. But then you're going to get a loan, right? That's what we call that senior secured loan, because it's that first lien position. If you stop paying your mortgage, the bank's going to take it. That's the person that gets to take it. That's the safest spot, right? And those investor, that bank's an investor, right? They have the lowest risk position because all the value of the common equity is on top. Preferred equity and mezz debt are kind of in between the down payment, right? Preferred equity has a senior position. Mezzanine debt is like a second. Like if you were to do a second loan to renovate your kitchen or something, you'd have mezzanine. Really, we focus on senior secured debt in this fund, and we're differentiating ourselves from common equity. And so what does it mean to invest in debt versus equity? It means that your priority payment, as we were saying, is lowest in common equity and highest, which means your potential return on debt, where it's fixed, it's really about downside protection on debt. It's fixed, it's typically fixed, whereas a common equity has the highest potential return. It's not fixed. which means that your recession resilience is lowest in common equity. We happen to be in a recession right now. And so a lot of equity investors are pulling back. They're worried about what's happening because there's volatility on the top of the equity, on the top of the capital stack with equity, which means the recession resilience is lowest. So when the market gets hit, the equity takes a hit. And there's a cushion to senior secured debt. So recession resilience is highest in debt. And it's important to know that your risk is directly proportional to where you're at on the capital stack. And this slide provides a really good example where if you buy a $10 million property and you put $4 million down, that's that initial common equity, okay? That means you're getting a $6 million loan. That's that senior debt, senior secured debt. That's a 60% loan to value, purchase price, right? But what happens in a recession if there's a 15% reduction in value? And that's happening all over the place across the country right now. And some even more so than that. But this is very conservative. What happened to the equity investors? 15% reduction in value means they lost 1.5 million. Simple math, 15% of 10 million. Well, that equates to a 37% loss for the common equity because they put in 4 million. Well, they lost 1.5. That's now 2.5 million they still have in the property. But where are the senior secured debt people sitting? They're sitting in a real safe location down there because they were at a 60% loan to value. They have this big they still have a 2.5 million cushion between their position, right? So 0% loss for senior secured debt. We talk about the returns, right? In a higher interest rate environment, where do you want to be? In the common equity side, higher interest payments on your loan reduces the profitability. It reduces your cash flow, and because it's harder to buy, it reduces valuations because people, if they're cash flowing less, they can't afford bigger properties, right? So the valuations drop. So it reduces your profitability. But on the first position, higher interest rates increase your returns. And that's what we're seeing in this higher interest rate environment today.
And just a heads up, you will get a copy of this as well emailed to you, so you can take a look at these charts. They're very helpful to help understand all this. We just want to make sure everybody understands that you'll get the replay to this webinar as well as this slide deck as well.
So why real estate private equity or private credit or debt that we're talking about? Well, you have relatively lower risk than common equity. You have higher returns than most other fixed income options. I mean, what are the fixed incomes out there? Some of them 1%, 2%, 3%. We're projecting a whole lot higher returns. It's non-correlated to the rise and fall of the stock market, and it's in that real estate asset-backed component on the bottom of the capital stack. That diversification gives you a better exposure for your portfolio with your allocations into this, not only being in a real estate asset-backed debt fund, but being in a diversified portfolio of loans, which really gives you that stability that you're looking for in that allocation of your capital that maybe you're not putting it higher risk equity plays. And most of our investors are going for equity deals, common equity deals, and they're going for debt because they really are different allocations for your portfolio. So why commercial real estate lending now? Well, it's really opportunistic timing. Banks are under a lot of pressure. We've all seen regional banks shut down. There's a liquidity crunch. They have issues. So they're pulling back on what are otherwise good loans. In addition to banks pulling back, debt is maturing. The need for debt is still there. In fact, there's $1.5 trillion in commercial real estate debt coming due by the end of 2025. So that leaves a lot of financially distressed operators, not just because banks being under pressure and debt maturing, but they're having a tough time. Post-COVID inflation, labor, taxes, and insurance are all on the rise, creating this environment when there's a lot of performing assets with owners which are financially challenged, and they're unable to get debt because banks are pulling back. All of that means we can provide higher returns to investors in the private lending environment. It's a really opportunistic time. And Lance can talk a little bit about how during the global financial crisis in 2009 and 10 was a big surge also in private credit in a similar way that it is today.
Yeah, definitely. Yeah, I mean, it was same issues that we had then. Do you want me to take this one too?
Sure.
Yes, I mean the big thing for us is that we're not doing single family homes. This is all commercial real estate assets. So these would be, multifamily properties, self-storage, industrial, retail. We don't do any office, but it just, not single family, which is a lot of private lending is to the single family space. And therefore we're not, dealing with situations where we're using an after repair value for our loan to value. So often when you lend on a private lending on a single family home, there's going to a rehab is going to take place, and they're going to come in and say, well, after we do the rehab, the house will be worth $500,000. And then that becomes, they lend them $400,000, right, for the loan, and they're basing their loan to value off of the 400,000 over the 500,000. So we don't do that. Ours is off of the as is value of the actual property. And then we focus on areas that are landlord friendly, so we don't have to worry about having issues with, evictions and things like that. Traditionally more red type states. And then someone had, mentioned it earlier. I mean, we're not focused on preferred equity or rescue capital per se, where we're trying to bail out some of these distressed assets. We're really more focused on people are looking to lend from us because they want, flexibility to acquire the assets, to get into it. And there's higher immediate cash flow, for the investors. Whereas, in pref equity, it's sort of like it's 14%, but you get half of it up, you get half of it real time, you have half of it deferred, and you're just in a subordinated position. So for us, because it's all cash flow, that's where you can get whatever we generate from that, the interest from the loans, you're getting to compound that all at the end of every month.
Lance, one question I know that's going to come up, it's come up for me, is just like, why are people doing these loans at like 13, 15, 16%? Like because obviously there are people that are borrowing at this rate. So why are they doing that?
Well, I mean, a lot of it right now is just because the traditional banks are just taking way too long to get deals done. So it's taking like 4 months to get a loan from a bank. And that's an issue because there's still competition in the market, especially now because you got all these real estate guys sitting on the sideline. So,
Yep.
so it's really just a matter of getting control of that asset, and then you can, refinance out with more conventional financing when that all comes together.
Well, yeah, I didn't mean to interrupt Lance, just because this just supports the whole conversation. Typical loans in the performing assets, 6 to 8%, and then essentially that is what was the yesteryear of years ago. But how do we get to 13%? Right, that's what we've been lending at. So interest rate hikes played a opportunistic component to it. It is not all of it, and but really the interest rate set by the Fed does not dictate interest rates in the common market. Demand does. And the demand is there because banks are in a liquidity crunch right now. They're pulling back, the pencil's down. They're taking a very long time to close. We're able to move very rapidly, which allows us to command higher, and we don't have all the red tape that banks do. We can do the same underwriting. We can just we move faster. And banks, not only are they taking, when they say 30 days, 60 days, and when they say 60 days, 90 days, and constantly changing their proceeds along the way because they're struggling with their liquidity issues, we have a reputation for closing. And that's the most important thing. Pointing to what Lance was just saying is that people need to be able to do deals in this environment. It's a turbulent environment, and they will pay a significantly higher rate just so they know that they can secure that asset and immediately begin their business plan. And banks just simply don't give you that confidence these days. And these two point at the $64 billion in distressed U.S. commercial property and $1.5 trillion in debt looming right now in commercial assets. And so those are the two more. And there's one on the subsequent slide there. Oh, there's one more that maybe didn't show up on your deck that, it was just Jerome Powell that said that currently today, commercial real estate impact on banking has yet to begin. And that just came out on the 6th of February. So pretty awesome time. So allocation strategy, Lance, you want to grab that one?
Yeah, so some of this we've been talking about. So really main focus is originating short-term bridge loans. So this is for those acquisitions, is the big one, right? Is just the ability for people to close quickly. So speed is, if you get anything out of today, like it's about the ability to get control of an asset and close quickly. So when we underwrite a deal, it could, take, anywhere 7 days to 14 days to close versus, like I said, banks are running at 4 months, even like family offices are at, 6 weeks, 8 weeks. So a lot of it is just they need to move closely. We also have the ability to acquire participation interests in other loans or just buy whole loans that originated by other people. We do have the ability to do some of this rescue capital. It's not to say that there aren't certain structures or situations where someone has a distressed asset, where maybe we can come in and take out the first position loan. But it's not really a focus of ours. We just think the big opportunity that we face right now is really more of this. There is distress in the market right now, and there's going to be competition for these assets, and people are going to need to move quickly with cash, and they're not necessarily going to have all of their equity raised yet, right? And they can't raise all the equity to take it down, nor can they wait for a bank to, show up 4 months later. It's 3.5 months too late to take care of that. And so then we do have an allocation for investing into other debt portfolios to kind of create, further diversification, where we've got exposure to someone else's portfolio. Then, as mentioned, where we focus is, you see more of this in kind of the Midwest and the Sun Belt, Southeast red states, as I mentioned, that are just more landlord friendly and lender friendly. So, we're really bullish on those markets. And as I mentioned, so this is like triple net assets, retail, industrial, multifamily properties that people are, looking for. Because we do have the other situation to have some of this bank debt is expiring, or their bridge loans coming due, and their lenders just sort of done with them. And that's the other thing, is that their options are go into default and have that, lose the asset, or once again, take the cash flow hit and, take the 13 or 14% mortgage and kind of kick the can down the road 6 months and hope that you can find, more conventional financing as you turn it around. Because a lot of these things too, it is just a matter of turnaround. I know people have seen this where evictions are backed up in Georgia, places you wouldn't think you'd have issues like that are just destroying, kind of the asset's a good asset, right? But here they can't kick people out of the place and replace them. So there's just, every time distress hits markets like this, it just creates very interesting, unique opportunities. And a lot of times this is where it's just people need capital that can move quickly, that can come in and kind of help them out. And just to give you an example, here's a deal we did in Missouri. This is a retail strip center. It was a $2 million loan. The borrower acquired the asset for $4 million. I think it was 40% vacant, but it was still at a 10.2 cap. So it was still a strong, really strong cash flowing asset, even though it's 40% vacant. And the operator, the people that used to own it, just were sort of asleep at the switch and, really weren't trying to do it. So our borrower came in, had the opportunity to acquire this asset, and we were able to move quickly, and we borrowed them $2 million. And, I think they're up to almost pushing 70% occupancy now on the asset. It was a 13% interest rate mortgage, 2% origination fees. And then they do have it's a 6-month loan with a 6-month extension, and that's in first position. So that's a great asset. It's just a great example of, in this case, where it's a really strong cash flowing asset and they just don't want to hassle with conventional financing. And in this case, it's sort of a value add play where they really don't intend on holding this asset for much more than a year anyhow.
Yeah, that immediately appraised for north of 5 million. So our position is even stronger than we thought. And the borrowers was looking at potentially 60, 90-day close on a loan without a lot of trust that would happen. And we were able to do our underwriting and move faster.
Yep. And then another example of this is a single tenant building retail as well that had a $800,000 purchase price. So we lent 50 cents on the dollar there, $400,000, 13% to origination points in the same structures. This deal was in Georgia, first position with a going in cap rate of a 9. So it just shows you that for many real estate owners and operators, they view capital, having flexibility and the ability to move quickly. They just it's just the cost of doing business, right? Because they know something other people don't know. And then here'd be an example of like a gap loan where this particular property, come on the market, someone needs to move quickly. Same thing, or pay a little bit more. It's 3 months, they've got the lender lined up. They just need the capital to close on the deal. And then a bit about our strategic partners. So, we work with Gerasi Law Firm out of Southern California. They service many of the debt funds. I've been working with these guys since 2011. We use a third-party loan servicer called Superior Loan Servicing. They've been around forever, known those guys for years. And then Spiegel Accountancy Corp. They're up in Northern California. I've been working with them since 2012. And many of my clients use them. We use them to audit our funds and do all our tax returns. So I'm super tight with the team. So this is kind of the dream team of the lending space. And I've known these guys for most of my career. And then we also, much like with our securities counsel, I've been working with him since 2008. Taught me a lot of what I know about all this stuff. He's a great guy. And we have a third-party fund administrator. And we use a technology platform called Cash Flow Portal.
So this will have an investment portal to investors can log in and see their investment and get distributions from it. It's a very nice setup for investors.
Yeah.
And Bronson was already using Wallace for quite some time too. So synergies there.
Yeah, great team. I mean, everybody involved, I'm really excited about. That's a big part of any deal, is just making sure you like and trust who you're working with. So
this is just a summary breakdown of the investments. You got the 90, 180, 1 year for the fixed interest short-term investments. Those are the senior secured notes, 7, 8.5, and 10% respectively. 100,000 minimum is what Bronson's offering across the board for these. All the investments are monthly. Senior secured notes provide monthly distributions that can be reinvested and compounded monthly. Long term, that's the 3-year plus. So it's not a 3-year fixed, it's a 3-year plus until you choose to redeem all or part. You have flexibility on your redemption. And then there's the Class B and Class A. Class A gets you in for 250 and Class B gets you in for 100. That allows you for monthly distributions. Monthly, in between the quarter, we stay current on the preferred return. And you can see that's 9% for the Class B and 10% for the Class A. And then we'll settle up with you on the split on a quarterly basis. So we stay current on the pref and settle up on the split at the end of the quarter, because we don't know exactly what the quarter is going to turn out as till the end there. So you can compound that monthly. And there's a question I saw in the chat, can you switch back and forth? Most certainly you can. And a lot of investors will look at this saying, look, I don't need the cash today, but maybe in 5 years I might retire. So let's compound that, and which is impressive. We're trending around a 15% in the Class A shares. Compounding that monthly, that's a pretty strong return considering the low risk asset. And then one day you say, hey, look, Bronson, I'd like to start getting distributions on that. You'll start getting distributions on the compounded amount later on down the road. And it's something that you can change.
So again, just to clarify, we got shorter term stuff here that's lower rates, but it locks your money up for less, up to a year or less. Over here on the right, it's 3-year minimum, and then you do share into the profit share on the upsides. These are pretty sizable returns. You can see the total projected returns. It could be even higher than 12.5. It just depends on how things perform, but it could be very handsome. So, let's see. You want me to go through this, or you guys want to go through this?
Yeah, this is the typical stuff. The accredited investors, 200,000 in income for an individual, 300,000 when combined with their spouse, or $1 million in net worth. Is to check the box of accredited investors. A couple other ways, but we accept funds, SD IRAs, 401ks, EQRPs, all the above, cash. Bronson said his minimum 100,000.
Yeah, first come, first serve.
And the process through the portal. You jump into the portal. I'm sure lots of people here have invested through investment portals, but you see the link there, bronsonequity.com/debt fund there to get access to that. It's a very simple, easy e-sign process in the portal. So it's very straightforward. And you provide the funding. You can actually ACH your funds directly through the portal, or you can send wires or ACH directly through the bank. And then you send it back. It's a passive investment.
Yeah, I just stuck that in the chat too. Actually, it's right here as well. You can either schedule a call, or here's the address down here on the bottom. This is our last slide. We're going to do some Q&A at this point, so we'd love to take some questions. Thank you, Lance and Patrick, for this. I know we're getting quite a few questions. The question is, what's the cutoff for funding? I mean, it's really first come, first serve. So hopefully we do hope to kind of offer this as an ongoing basis. But again, we have availability now. We may not have it later. It's kind of whatever is available. All of these senior liens are first position. Just correct me if I'm wrong. I'm going to answer some of these kind of faster. They all are first position. And then what's the total loan to value? We're talking less than 65%, typically around 50%. Is that correct, Lance?
Yeah.
Or Patrick? Yeah.
Yeah, so we say in even our offering doc says 65%, and there's some guardrails there that if something shifts, we need to make some adjustments to get us back into that. But so far, we've been trending below that. As we mentioned before, we do have some flexibility to go outside the first lien position within the guidelines of our offering documents, but we've made it very clear that hasn't been our intention. It's not what we're doing, but at Rescue Capital and some other particular opportunities with high net worth sponsors with collateral and other assets can make that attractive. And if a deal were to ever fall apart, then sometimes you'll switch to another product like that to contain and get more collateral on these assets. So, but the primary focus is on those first positions. Go ahead, Lance.
If we did a deal, we'd be cross collateralizing many other assets to get into our loan to value range if we were behind other people. But it's got to be a really strong borrower, really strong asset with an abundance of collateral.
The tax benefit, any tax benefits with this investment?
No, and it's important to know that you can't always let the tax tail wag the dog. And it's great to always do tax advantage, but the reason why that they're tax advantage is because they're higher risk. And the government's incentivizing you to take that risk with tax advantage. When you're doing debt funds, as you saw in the Tiger 21 allocation, the allocation of the wealthy, there are fixed, the 7% is their allocation for fixed income and 26% in real estate. And it's important to know that there are some aspects of your portfolio that allow you to rest easy that don't always have to be tax efficient. So that's important. It's an important piece of your portfolio.
What would you say the biggest risks to the investor are in this type of a deal?
Us not getting the value right when we make a loan. The valuation of assets, right? If you're not good at underwriting the value of an asset, and you think that it's worth X, but it's actually worth X less 20%, right? So what you thought was a 60% loan to value is actually 80% loan to value. That's where people get stuck in this business. They're just not good at understanding the value.
Yeah, so you're at the 40, 60%. I think the risk I see is what if there was a crash maybe too, and that would be a temporary valuation drop in the asset class. And that's where we point back to the capital stack that, so right now we're trending 40 to 50% loan to value. There's a lot of cushion up on the north side of that for the debt investors to be strong. But it may be that potentially if we have to take an asset back, that's fine. We're in a good position. But it may be that the risk is distributions potentially dropping if we're in the middle of taking an asset back. But the whole point of being in a diversified portfolio is that will even out across the portfolio. And in the end, it's potentially a big win for the fund because we've gotten an asset, at an extremely low
In my
loan to value.
experience too, is that when borrowers have a lot of equity in a deal, they fight for it. Right. So that is when they don't, they won't. And now, but when we underwrite it like, would we want to own this asset? If yes, then we'll proceed further. If no, then we turn it down.
Hey guys, we're going to go rapid fire here. We got a bunch more questions and I want to try to get to some of them. So, short answers are not to be one word, but yes, no, maybe. But what happens when interest rates normalize? Like what happens in this when interest rates go down to where they were a few years ago?
Yeah, I mean, it's good news, bad news, right? They're not that correlated to when interest rates rise and fall, or they just don't move at the same pace. And so, when I was doing this back in, a lot more in, 2012, 13, 14, 15, I mean, we were still at the same rate. So it was still charging 12, 13, 14, 15%. So it just, they don't move at the same pace. So will they go down a little bit? Yeah, but it's not, if rates go down, the Fed drops the rates down 300 basis points, these rates won't go down 300 basis points, maybe 1%.
Yeah, it doesn't affect the loans that are out too. It'll affect when they go back and refinance or other things too. Question: since loans carry, these loans are much higher interest rates, does that mean that CRE assets have greater risks as no banks want to loan to them, or is it just simply the speed of being able to close and some of the other factors that you mentioned?
It's simply speed. I mean, it's a matter of if they've got 40% equity into the deal, like they're gonna some bank will do it. It's just really hard at the moment, and we just do see banks, pulling back more and more and more, and that's why the loans for us are 6 months, and we'll give another 6 month extension. I mean, our intention here is to move them out.
How much will each partner be investing? Lance, Patrick, Bronson?
Yes, I think
what's our co-invest management? Go ahead.
yeah. So I think, yeah, I mean, we're committed to putting $1 million into the master fund. I don't know if you're thinking about putting anything into the feeder fund here, Bronson, but
Yeah, I'm probably gonna, I haven't determined exactly, probably, at minimum of 25 to 50K, but more for sure. I mean, I don't have, sounds like Lance has super deep pockets and very liquid right now. So
no, over time.
if the borrower defaults on the loan payment, the action would be foreclosure, correct? You'd foreclose and go in and operate. And because we have operational experience on the team, we could come in and take over the asset and run that if needed, right?
Yeah, for sure. Yeah, for sure. I mean, I mean, that's where, yeah, I mean, immediately if they're in default, we're gonna file for foreclosure. And, like I said, if in this case, if we got the loan to value right and they got 40% equity in it, they're
They're
gonna
not gonna
move
want to do that.
mountains to try to
Yeah.
to try to, work it out.
Yeah.
And
And
something else that's
valuations have already
important to know
come.
is,
Go ahead. Go ahead, brother.
well, something else is important to know is that people that buy properties think, oh, it's really hard to buy and sell assets. It takes a long time. But that's not when you're buying and selling paper, especially paper at interest rates and at loan to values. Like there are whole exchanges and companies that have non-performing loan portfolios that aren't cash flow based. And if something becomes not performing, and we've got so much upside, we could probably still sell it to a non-performing loan and portfolio at a profit and exit quickly, or we could take the asset, right? So there's a lot more options when you're moving paper, which you can sell overnight, which banks do all the time, right? Some just originate and sell and originate and sell.
Yep.
But this gives you a lot more flexibility to ride out and to pivot moving forward as the landscape changes.
No question.
Todd is asking on 13% interest rate, your spread is 6% for short-term notes. I know we have kind of a mix of long and short-term. So can somebody talk about the spread of generally what?
Yeah, I mean, I replied to that one. So I mean,
Okay.
yeah. So ultimately, if you have a 90-day note at 7.5%, you sort of see the beauty of this, right? Is that the Class A and Class B members are the beneficiaries of the spread we would generate in that scenario. Now, with that said, we generally will be parking 7.5% money into just more liquid stuff. So our spread we have just some shorter term products that don't have that kind of rate. So we're always trying to maintain and manage liquidity in the fund. And in all cases, most of the stuff that we're investing in is just, like I said, it's not 3-year paper. This is 1-year max type stuff. But yeah, that's the benefit for being a Class A and Class B members. And it's why we've had such high returns in the first, few months of the fund, is because some of that people looking for more of that highly liquid notes. And so it's just the Class A and Class B members are just getting more of the benefit.
So Susie's asking, can I start with reinvestment and then switch to distributing later? That's correct. I mean, you can reinvest along the way. You can distribute. You can change, how you're invested. You can change some of that. The 3-year reference, Rick, this will be sent out to you. So we will send out the slideshow shortly once we get this all set up. Lance is the underwriter, 20 years of underwriting. Can you split up your 100K in both short? Oh, you've already answered some of these questions, Lance. I appreciate that.
Yeah.
You can split up between a couple options. So it looks like some of this stuff is already being answered. I'm gonna take some of the newer questions here, and then we're gonna kind of wrap. And if you have additional questions, we do want to get to them. We just may have to do it offline, if that's okay. We did answer that one. When interest rates come down, how much demand is there for these loans? What's your current offering size?
Well, it's an evergreen offering. So, I mean, in a perfect world, this fund, would be open indefinitely forever. So we don't have a max offering. And the demand for this type of loan never goes away. There's always situations people have equity in properties, death, divorce, right? All these life situations, taxes. So that, some of the stuff we didn't even talk about, there's always demand for it. People have equity in properties. They need to get access to equity or access to, some of that equity. We fill that void as well. So, and if anything, it's just growing because banks are becoming more, just over time, they're just less interested in lending and more interested in generating fees off their account holders.
So Todd is asking, why does it take 60 days to access, or 60 days to access our liquidity for short-term notes? Does that mean that people need to give a 60-day notice if they're going to
Yeah,
be taking a
it's just a
distribution?
cash out provision. So if you buy a 90-day note, I mean, it's more of just letting Bronson know that, like, listen, I'd really only need this out for 90 days. That's sufficient. It's just, we just want to know that, okay, this 90-day note, you're not going to want to roll it over. If you're undecided, that's fine. We're just saying, just give us a 60-day heads up. Like, so I know it's short time but usually people are buying the 90-day note. There's a reason why. So they're just like, I really just need to park this for 90 days. But it's more of just so we can plan and make sure that we have liquidity there.
Okay, some of these can be answered. I know some of you guys are jumping in the chat here as well to kind of answer some of these, so I appreciate that. So anyway, we will, I think we got minimum loan to value is, I guess the max loan to value is 65%. The average was the average around 50%, 60%, somewhere in that range.
Yeah, we're at 50%
Yeah,
now.
trading 40 to 50 right now.
Okay, so very low leverage. So anyway, what we want to do is, if you have additional questions here, there's a phone number down here. We also have my email here. I'm around tomorrow, so if you wanted to chat if you have a few minutes today, we can chat tomorrow. Would love to connect on this. If you do want to find more information and want to kind of sign up, hey, I'm interested. We have a soft reserve process. It doesn't commit you to anything. It's just like kind of raising your hand, like, hey, I think I'm interested in this, and I want to kind of see what the next steps are. You're going to go to this bronsonequity.com, the debt fund here, and what this is going to allow you to do is, I think I just pasted something in here that was kind of weird. Anyway, I think I messed up this page. Oh, there it is. So anyway, we've had a couple technical issues today, but it's going to be resolved. So you'll go there, you'll get on our portal, and then we'll get next steps to you on how you'll kind of work through the paperwork, and we'll get you all set up on that. It's an easy process. But anyway, I just wanted to say, again, we try to stay right about an hour, a little less than an hour. So anything, Patrick, Lance, you guys want to say as we wrap up here?
I appreciate everybody's time this evening. Happy to help support any questions that you have, and look forward to investing with you.
Awesome, guys. Well, really appreciate you being here. Thank you, Lance, Patrick. Thank you for everybody that joined us today. Again, if you are interested, again, this is a very unique type of investment we've never offered. And I think right now there's a lot of people that are looking for having something steady and solid that has some flexibility to it, allows you to to get in or out as needed, maybe has some upside. And I kind of, in the past, to be honest, I wondered why people did debt investments like this, but now we see, right, because of what we've been through recently, to see why people want to be higher up in the stack, just because they are, at a more secure position in the stack. So anyway, guys, I really appreciate you being here. Thank you again. And if you do have questions, feel free to shoot an email, give me a call. You can, go to that website, the bronsonequity.com/debt fund, and we'll look forward to connecting. And thank you again, guys. Appreciate everybody for being here.
Thanks, everyone.
Thanks, guys.